When immense structural pressure builds up unnoticed on a flawed foundation, the subsequent collapse happens all at once. On May 6, 2010, the U.S. financial markets experienced this kind of structural failure. Algorithms suddenly offloaded billions of dollars in index futures into an illiquid market. This chart shows the Dow Jones, S&P 500, and E-mini futures plunging in lockstep between 2:24 p.m. and 3:36 p.m. The selling pressure transferred across all major exchanges in a matter of minutes. To measure execution quality during intense volatility like this, institutions rely on the volume-weighted average price, or VWAP. It calculates the fair value of an asset by tracking the cost basis of traded volume over time. The default settings for this indicator carry a vulnerability. Applying calendar-based VWAP calculations to multi-day events produces severe distortions, leaving swing traders out of position. The error originates with the morning bell. At 9:30 a.m. Eastern Standard Time, standard trading platforms automatically wipe their volume tracking and start over from zero. The daily rotation of the Earth on its axis has absolutely no bearing on the actual order flow. Market cycles are triggered by information shocks, surprise earnings announcements, macro data releases, or algorithmic liquidations. Retail participants anchor their decision-making to the daily open. Institutional capital anchors its positioning to supply and demand imbalances, regardless of what day it is. To track that institutional capital, we have to map the math directly to the event. This requires a calculation known as event-anchored VWAP, which tracks cost basis over continuous trading sessions. True institutional memory completely ignores the clock. It is entirely bound by the structural events where major capital changes hands. This equation shows the mechanics of VWAP, price multiplied by volume divided by total volume. When a massive order hits the tape, the volume denominator swells, anchoring the average price to that specific trading range. But the math breaks the next morning. At the open, an automated parameter, t equals 0, activates. This variable resets the cumulative volume denominator to 0. The mathematical weight of yesterday's heavy accumulation is instantly deleted. The indicator now suffers from mathematical amnesia. It is blind to the institutional conviction established just hours prior. 1 million shares absorbed on a Tuesday afternoon disappear from the calculation. By Wednesday morning, standard VWAP treats a single 100-share retail trade at the open with the same mathematical authority. The default design of retail trading platforms forces users to operate without context, blind to the actual multi-day cost basis of large funds. Market efficiency relies on prices reacting to new information. Using event study methodology, we can pinpoint how these shocks initiate new phases of price action. This chart shows a reconstructed minute-by-minute order flow sequence tracking a systemic liquidation. Notice the spike in volume at the bottom of the decline. That specific candle represents the moment algorithmic selling exhausts the available liquidity. We define this capitulation point as T0. It is the structural start of a new market cycle. When high-frequency algorithms clear the order book at these extremes, they wipe clean previous market sentiment and establish a baseline for future valuation. This supply-demand imbalance creates a definitive origin point. Its mathematical validity comes from the intense exchange of shares, not its position on a calendar. Identifying this capitulation point provides the data origin needed to calculate the recovery. This split screen compares standard daily VWAP against an event-anchored VWAP during a 3-day recovery. On the left, the daily VWAP severs its connection to the data at the start of each new morning. Because it starts with a 0 volume denominator, low-conviction retail flow pulls the mean off its center. Price slices through this daily line repeatedly, generating false breakout and breakdown signals. On the right, the anchored VWAP remains locked to the T0 capitulation point, ignoring morning bells. Over the 3 days, the anchored line forms a smooth curve, factoring in the aggregate cost basis of institutions. When the price tests the line, it bounces cleanly. The anchored VWAP is acting as structural support. The difference is the denominator. The anchored calculation retains the millions of shares traded during the initial crash event. That retained mathematical weight acts as an anchor. It filters out the low-volume noise of daily retail volatility. Comparative order flow data shows the daily reset creates a market illusion. Event anchoring reveals the actual center of institutional gravity. Expanding the anchored chart allows us to look past the math and observe the structural narrative. In the classical Wyckoff market cycle, an asset transitions from a markdown phase into a period of quiet, sideways accumulation. Wyckoff theory uses the concept of a composite operator to model the behavior of well-capitalized institutions. This entity absorbs supply systematically to avoid driving up the price prematurely. The anchored VWAP traces where the composite operator is active. Every time price nears the anchored cost basis, institutions accumulate more shares. Once supply is exhausted, the market enters the markup phase. Buying is complete and price moves away from the support level. This alignment between modern quantitative metrics and classical market microstructure theory confirms the underlying mechanics of order flow. These support levels manifest as the mathematical footprints of institutional accumulation. Relying on calendar-based trading metrics is an error in an environment dominated by continuous global capital. The market microstructure does not care if the sun is rising on a Tuesday or a Wednesday. It only cares at what specific price capital was deployed. For a quantitative trader, the protocol is explicit. First, visually identify the structural information shock on the chart, whether it's an earnings gap, a macro data release, or a forced liquidation. Next, place the VWAP origin on the highest volume node of that specific event. This calculation provides a mathematical method for stripping out retail noise and isolating the institutional signal during a multi-day trend. Anchor to the event. Ignore the calendar. Mapping institutional memory provides the context required to survive multi-day trends.